India's crackdown on Jane Street, a bold move for market integrity or too late to matter. In a dramatic and unprecedented move, India's market regulator, the Securities and Exchange Board of India (SEBI), has barred US-based quantitative trading giant Jane Street from accessing its securities markets. This is not just an isolated action against one firm, it represents a broader assertion of regulatory authority and a critical test of market transparency in India's fast-growing financial sector. The allegations, manipulation in plain sight. According to SEBI, Jane Street allegedly manipulated India's major stock indexes Bank Nifty and Nifty 50 to generate unlawful gains through options trading. This alleged intraday index manipulation and marking the close strategy allowed the firm to influence price movements to its benefit, misleading the market and causing losses to smaller retail investors who were unaware of the distortion. A timely or tardy move. While SEBI's action appears firm, it came after more than 15 months of ongoing market surveillance. This delay raises critical concerns about the regulator's capacity to detect and respond to high-frequency, algorithmic market manipulation in real time. Could billions in unlawful profits have been prevented with swifter action? A strong message to global investors. The order sends a strong message to global investors. India will not tolerate market abuse, regardless of the offender's global stature. But there's a fine balance. Such bold actions must be fair, evidence-based, and transparent to avoid spooking genuine foreign investors who might now worry about regulatory unpredictability. Retail investor protection. Real or rhetoric. SEBI has claimed that the action was taken to protect retail investors. However, this brings up important questions. How aware or educated are India's retail investors about complex derivatives and index manipulation? Are regulators doing enough to promote financial literacy, or is investor protection limited to after-the-fact enforcement, lessons, and the road ahead? This case offers several key takeaways. 1. Stronger, real-time surveillance tools are needed to detect manipulative behavior early. 2. Derivative markets, especially index-based options, require tighter scrutiny, particularly when large players are involved. 3. Retail investor education must be prioritized to help individuals navigate increasingly complex markets. Conclusion: the ban on Jane Street marks a bold assertion of regulatory will and a symbolic defense of market integrity. It shows that India is serious about cracking down on financial misconduct even when it involves global powerhouses. But this also exposes gaps in regulatory response time and market oversight. To truly strengthen its position as a trusted investment destination, India must back such actions with systemic reforms, transparent processes, and proactive investor support.